The last week or so has been a roller coaster ride for the market, mostly because of the threat of large US tariffs. Thankfully, both the American and Canadian governments have come to an agreement and the tariffs have been postponed, but only temporarily. In early March, these tariffs may very well be back on the table. This means that even though many stocks have since rebounded, we could still see a crash of similar or larger proportions. So in this video, I want to take a look at what impact a trade war could have on the economy and the stock market, as well as if these risks should deter investors from investing. My name is Paul, and I've been investing $100 of real money into Canadian securities each month on this YouTube channel for over 3 years, with the goal of highlighting the investment journey of a hypothetical Canadian who will never be able to max out their tax-free savings account. My hypothesis is that people who only have a little bit to set aside at the end of each month can still achieve financial freedom by following a disciplined plan of investing what they can on a consistent basis. So make sure to stick around to after the main topic to see how the journey has been going. Taking a look at the timeline of events, Donald Trump wrote the 25% tariffs on Canada and Mexico into law on February 1st, and when the markets opened on the 3rd, stocks began plummeting, with the American market reaching a peak low of about 3.1%, and the Canadian market dropping to about 3.4% from the previous day's close. But these are the intraday numbers, and partway through the trading day, Trump came to an agreement with Mexico to delay their tariffs, which saw both markets start bouncing back. Meanwhile, Trudeau and Trump would similarly come to terms later on that evening, postponing the tariffs for 30 days. So the question is, what information can we glean from this? Well, first off, I think it's highly likely that the market would have continued to drop further if the tariffs would have remained in place. It's hard to imagine that the vast majority of investors were fully aware of the implications and were available to place trades in the brief time period between when the tariffs were initiated and when they were retracted. Second, we don't know exactly how impactful these tariffs will be even now. If they do go into effect, there will be a negative impact on consumers, businesses, and shareholders, but the extent of the damage is very difficult to be certain of. For instance, we don't know how long the tariffs will last, how the Canadian government will react to ease or strengthen the blow, what downstream effects policy changes will have, or if the tariffs will even be renewed after the 30-day period expires. Thirdly, we know that Canada has no intention of backing down if the tariffs are renewed. Trudeau and all of the major contenders for his successorship are in support of rate matching for any tariffs placed on Canada. One of the most credible projections for how the tariffs will impact Canada came from the Bank of Canada's January 2025 Monetary Policy Report, where it was projected that if the tariffs go into effect for an extended time period of 3 years, we'll most likely see GDP drop by about 3.94% before plateauing. This would plunge the median household income by about $2,775 per year by the end of the 3-year period. But that's not the only impact. The tariffs would also likely push the inflation rate up by 1.61% over the same 3-year period. Now, it's worth noting that this would be added on top of the standard inflation rate, which last year was about 2.4% in Canada, though inflation has been trending downwards post-COVID. Assuming Canada manages to get back and maintain its goal of a 2% rate of inflation, by the end of 2027, inflation will have compounded to the effect of 7.79%. That said, inflation does tend to have a positive impact on wages, but more recently, real wage growth has been trailing inflation by about 1%, though the outlier, the labor force survey, does show some modest growth to real wages. Personally, I think it's a good idea to be cautious, so let's conservatively assume that wages cover about half of the increase in inflation. Adding that to the 3.94% hit to GDP, and by the end of 2027, the total impact would be somewhere in the ballpark of negative 7.8%, or a loss of $5,520 to the median Canadian household. This means that the average purchasing power of the Canadian household would be expected to drop from $70,500 today to the equivalent of about $64,975 in 2027. This model is assuming a 25% tariff from the US and a 25% counter tariff from Canada, and the results already look devastating. This would be terrible for consumers who spend their money at businesses, whose sales and earnings metrics are used to value shares that investors purchase on stock exchanges like the TSX. So these tariffs will have similarly negative impacts on the market. Fortunately, the tariffs still aren't guaranteed to be put into effect, but we only have about a month until they're back up for discussion, and Trump did say that he would impose additional tariffs if Canada retaliates, which we almost certainly would. Now, to be perfectly transparent, those threats were made before the agreement was reached, but I definitely wouldn't comfortably assert that the additional rate increases are not going to be brought back up in the future. What's worse is that if a trade war with rising tariffs does play out to the tune of an additional 10 or 20% or more, then the projections I just went through might prove to be comparably mild. On the other hand, there are things that Canada can do to mitigate the economic blow and possibly even stimulate growth. For example, there are several different forms of trade barriers negatively impacting interprovincial trading within Canada. According to a 2019 International Monetary Fund paper entitled Internal Trade in Canada, The Case for Liberalization, authors Jorge Alvarez, Ivo Kersnar, and Trevor Tome estimate that the removal of these trade barriers could increase Canada's GDP by roughly 4%. This could completely negate the effect that the Trump tariffs are projected to have on Canada. The article states, the average tariff equivalent non-geographic barriers in 2015 was 21%. Across sectors, these range from 7% for textiles, petroleum, and chemicals to over 27% for heavier metals, food products, and other manufacturing goods, and significantly higher for services, which can be upwards of 50%. The paper goes on to theorize that the federal government could force trade liberalization since, under the Constitution Act, the federal government has full control over trade and commerce. However, this control seems to be less full in practice as it clashes with provincial civil and property rights. And in the past, the Supreme Court has ruled in favor of provinces placing fines on goods entering their province. So, because of protectionist policies and differing regulations between provinces, these barriers can be hard to remove or work around, though things have been getting better over time. However, I don't think it's likely that free trade among provinces will happen overnight, even if America does implement very heavy tariffs on Canada. There are just too many differences in regulations and policies that need to be adjusted to make things work. I do expect that this will happen eventually, but getting people on both sides to come around and agree to make compromise tends to be a slow-moving process, especially when there are special interest groups who, in certain circumstances, benefit from the status quo. Another lever that the majority of serious candidates for Canada's next Prime Minister are grasping at is rolling back on climate protection initiatives that are costing consumers or hampering GDP growth. For instance, the clear progressive conservative candidate, Pierre Poilievre, is for cutting the carbon tax, expanding liquid natural gas production, and building out crude oil refineries so that Canada can realize the full value of its oil abroad, sidestepping our reliance on US refineries. Meanwhile, one of the top Liberal candidates, Mark Carney, has similar positions, vowing to immediately remove the carbon tax if elected. He also plans to expand LNG production and build out refineries with carbon capture storage systems to help offset emissions. Another top Liberal candidate, Chrystia Freeland, said that she would also scrap the carbon tax, though she's yet to speak publicly on expanding Canada's energy production. Then we have Karina Gould, who is the only serious Liberal candidate who appears to be interested in leaving the carbon tax in place, though even she is opposed to Trudeau's attempts to raise it. This is a huge change in course from the prior Liberal leadership's stance, and it points towards a softening interest in combating climate change at the cost of economic growth and the consumer. That said, there are tons of unknown variables here. Who will win the 2025 election? How will they implement their policies? Will those policies be effective, and to what degree? How long will they take to enact their policies? Will trade barriers decrease, and if so, by how much? Will there be more tariffs, and will they be at higher rates? All of these are questions that only time can answer, and there are near limitless possibilities for other unknown impactful variables that could come down the pike. Honestly, You might be better off buying a lottery ticket than trying to predict how the future will play out in the economy. This is why, when it comes to investing, your best bet is going to be focusing on what is in your purview to understand. That being businesses who generate free cash flow with long runways of growth and minimal risk of going belly up, even when the water gets murky. One company that meets this criteria for me is MTY Food Group. MTY is a restaurant company who owns and franchises out 90 different brands, including Cold Stone Creamery, Wetzel's Pretzels, Papa Murphy's, Sweet Frog, and many more. This company has a management team that is really good at utilizing large amounts of debt to their benefit, finding ways to make large deals, and using the company's immense free cash flow to pay that debt back down. Thanks to this strategic utilization of the debt, the company was able to acquire some strong brands that were immediately accretive to the free cash flow, which is now at record highs despite 2024 being a year full of economic headwinds for most restaurants. With this strong growth to the bottom line and speedy repayment of its debt, on January 22nd, MTY announced that it will be raising its quarterly dividend by a solid 18%, pushing the payout per share from 28 to 33 cents. This bumps the trailing 12-month free cash flow payout ratio to a very modest 17.2%, which leaves tons and tons of room for dividend growth in future years. Over the course of the month, MTY shares are up over 5.5%, ending the month at $48.75. But just before the tariffs were announced, shares were pushing $53, which would have tacked on an additional 10% of gains. So even in the short term, this one still appears to be providing an excellent investment opportunity, especially with shares trading at just over 6 times the trailing 12 months free cash flow. Another company that fits the bill is GoEasy, and GoEasy is an ethical lender of money to non-prime borrowers, and it provides payment plans that are easy to understand and flexible. Unlike MTY, GoEasy is still in the rapid expansion stage of its business. So rather than paying down debt, it's actively taking on more to grow its loan book. But the growth is very strong and highly profitable, usually expanding by 20% plus per quarter. And GoEasy is a company that routinely beats on earnings and outperforms their guidance metrics, which is why over the long run the company has substantially outperformed the broader stock market. But recently, the stock has been held back by the announcement of the CEO's departure, which saw Jason Mullins take up an opportunity in the States. In the meantime, GoEasy has been searching for a permanent replacement for Mullins, and this process is still ongoing, which has been hurting the price, since many investors hate uncertainty. So, in the month of January, the share price declined by a meager 0.3% to $167. However, pre-tariffs, the shares were soaring near all-time highs, pushing beyond $193 per share. And also, like MTY, GoEasy is a quarterly dividend payer with a modest payout ratio, leaving plenty of room for growth in the coming years. Finally, the security that I've been investing into the most is the Morguard North American Residential REIT. The trust owns and rents out apartment units located in major cities and urban areas throughout Canada and the United States. The simplest way to explain this investment is that it is pure value. The REIT generates a substantial amount of rent from its properties that it disperses in a monthly dividend that yields about 4.4% annually. But more importantly, investors gain ownership of prime real estate at a massive discount to the net asset value. The net value of the REIT's properties amount to over $51 per share, yet investors can buy shares for close to $17 on the market. And it's not like the REIT is in decline. Rent growth has been consistent with stable occupancy, and the REIT has a newer average property age than any other residential REIT on the market. But it still has the largest discount to tangible book value of all of its peers. The cherry on top is that the management realizes this, and they've been allocating excess capital to repurchasing shares, which takes advantage of the discount and provides long-term rewards for shareholders. In spite of this, the REIT declined by about 2% in January, and unlike MTY and GoEasy, MRG shares were only briefly impacted by the tariff announcement, and the price recovered almost immediately afterwards. On the whole, while the tariff news did throw a spanner into the works, thanks to all the dividends earned, my portfolio did eke out a positive result in January. All in all, the portfolio is up roughly 3%, or $118 on the $3,900 that's been invested into the portfolio. But that also includes $200 of reinvested dividends. So in actuality, my portfolio is up closer to $318 on the money that I've personally put into the investment account on Wealthsimple. Now, this month was pretty big in terms of dividends for the ETF benchmarks, and they all accordingly had a pretty strong start to 2025. But the out-and-out best performer is still the S&P 500. Despite it being near record high earnings multiples, it just keeps growing. Unfortunately, my portfolio continued to underperform, and it's the only one that's below the red line with the stars, which represents a 12% annualized rate of return on invested capital. As things stand right now, I need the portfolio to increase by about 9.7% in order to get back on track. But with earnings for all of my holdings coming up this month, I am optimistic about the future. Speaking of which, I was able to invest the $100 that I deposited into the Wealthsimple account, as well as the dividends that I received in January. So I first picked up 4 shares of the Morguard North American Residential REIT for $17.15 each. Then I purchased 0.3125 shares of M2I Food Group at a cost basis of $48 even per whole share. And lastly, I spent what was left over on 0.1724 shares of GoEasy at a cost basis of $167.64 per whole share, leaving my portfolio with 1 cent left over after my orders were filled. So, as the markets close on Friday, February the 7th, the portfolio has 167 shares of the Morguard North American Residential REIT worth roughly $2,860, about 17.6 shares of M2I Food Group worth just over $845, and 2.36 shares of GoEasy, which are now worth approximately $395. Heading over to the dividend tracking chart, in January, we earned dividend income from both the Morguard North American Residential REIT, which paid out $10.07, and GoEasy, which paid out $2.43, for a combined $12.50 in dividends. That's enough to buy this prepared in Canada bouquet of grocery store flowers for your Valentine. They aren't roses, but you kind of have to take what you can get when you're trying to be romantic on a budget. Thankfully, on this channel, we don't concern ourselves with the complexities of wooing, so we're just going to reinvest those dividends to try and achieve financial freedom as soon as possible. Speaking of, next month, thanks to M2I's dividend raise, we're projected to earn a record high $16.03 in earnings. So, at the risk of jinxing things, I think February will be pretty sweet. As for the portfolio's expected yield, assuming no changes are made to the portfolio or the dividend payouts, we can expect to receive $161.20 over the next 12 months. That's up 5% from last month, and most of that can be attributed to M2I's dividend raise. Meanwhile, the dividend yield on the money that I've personally contributed to the portfolio is up 9 basis points from last month, now sitting at 4.24%. And that's about all I have for this episode. But before you go, please remember that this video is not financial advice and that I am not a financial advisor. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions, and it should not be used as a substitute for doing your own research. This video does not have the information required to make good investment decisions on individual securities. So again, I am not a financial advisor. I'm just a Canadian who likes to invest and share my opinions with others, and in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing it with anyone else who may also benefit from it. Thank you for watching all the way to the end, and enjoy the rest of your day.